So today's webinar is on this book review. So it's the first time we are doing a book review on the webinar, and I think that it's worthwhile to share about this book because it can help us understand investing a lot better. And few people are very cognizant about this factor-based investing. So I want to share about what I learned from this book, as well as what I think it could be improved, and overall whether you should read it at all. All right. So that's the purpose of this webinar. And there's a question box which along the way, if you have questions, you can text them in. But I'll only address them after my presentation, which should take about half an hour. So we can leave about 15 minutes for the Q&A. Okay. Just to introduce myself, because some of you may not know me and it's first time hearing me speak. I'm the founder and CEO of Dr. Wealth, and previously we run a company called Big Fat Purse. All right, so it's still the same team. We still have the same mission, which I'll share about later. So I have written books on the secrets of Singapore Trading Gurus and Singapore Permanent Portfolio. All right, they are all available in the major bookstores, which you can purchase them. I'm also the creator and trainer of our flagship course, the Value Investing and the Dividend Investing Mastery courses. Okay, I also do quite regular public speaking in various settings and occasions. And our company mission is to help people who wants to do DIY investment to help you invest better. Okay, we believe that at the end of the day, you have to understand that you care about your money more than anybody else, right? Because it's your own money, and it makes sense that we have at least a know-how to learn how to manage our money better, and we want to provide that kind of education and tools to help you do so. So first of all, right, what is factor-based investing? This is a pretty new term, and it originated from the academic world, but there are very useful real-life applications that we can tap on this research. Okay, so this whole book is about explaining this factor-based investing concept to you, and what it's wonderful is that it's able to do it in a very layman manner, because as you know, research papers are very tough to understand, the words that they use, a lot of jargons, a lot of mathematical formulas, and they are quite difficult to read for laymen. So this book does that justice for you. So even if you don't want to read the research paper, you can always refer to this book, which pretty much cover the essence of the developments in factor-based investing for the last 20-30 years. So what is factor-based investing, right? So imagine this. There are investing gurus like Warren Buffett, George Soros, etc., etc. So each of them has like their own secret sauce to help them make extra excess investment returns over the years. And what they found out that is, what if I can break down this secret sauce into a few metrics, in a few factors that will give you the same performance as these investment gurus. So that set out how the academic community went to search for this secret sauce. Okay, and eventually they were able to break down these various gurus, whether they have alpha, no alpha, and whether certain exposure to this particular factor was how the stocks were being selected, for example. Okay, so essentially this factor-based investing is simplified way of replicating so those investors, those renowned superstar investors, how they actually invest. Okay, what metrics actually matters. And it started, I would say, in 1993, which was made famous by Eugene Fama and Kenneth French. So Eugene Fama is a Nobel laureate prize winner. Okay, and they were the two that found out that, hey, you know, things like value investing strategy do have excess returns, and they are able to show it with math using empirical evidence, where they dig through the stock prices in the past and certain metrics and show that, hey, yes, indeed, if you buy value stocks, if you buy small cap stocks, you actually do better than the market returns as a whole. All right, so that sets out the entire factor-based investing movement. And why they did even look at value in the first place was probably due to the successes of Benjamin Graham and his disciples that were able to deliver astounding results over the past 70, 80 years that piqued their interest and say, hey, why don't we just test whether this strategy really makes excess returns? And the academic community actually found that it is true. So value investing does have excess returns. The book, what it does well is it talks about at least 5 factors in terms of stocks. Okay, there are 5 factors that give you excess returns, and the factors do not only apply to stocks. There are factors that applies to bonds as well that give you excess returns. I will not cover these two terms in this webinar itself. So if you're interested, you can always read more about the bonds. I will touch more on the stocks because that was where the factor-based investing was started and began. So it's a lot more established. There's a lot more research on stocks factors rather than bonds factors. So over time, you'll see there are more factors that will be derived in the other asset classes, and it takes some time to mature. So we'll touch on only the stocks, which are pretty much quite mature at this point in time, where there's a lot more practical applications that we can use. So in order for a metric to become a factor, right, or a group of metrics to become a factor, it must fulfill 5 criteria. So this is what the academic community used, and Sweejo and Birkin did well to explain these 5 reasons. So first is that it must be persistent, which means a factor must work over long periods of time. It cannot be it worked for 5 years and then it doesn't work for another 50 years. Okay, so it must work for long periods of time, 50 years, 60 years, 70 years. Okay, so it must be persistent. And the second criteria is that it must be pervasive. That means it cannot just apply in the US. It must apply in Europe. It must apply in Asia and all around the world, and different regions and different sectors. All right, so it must be pervasive. And the third criteria is that it must be robust. So for example, a value factor, right, may have different definitions, like is low price to book, or it can be low price to earnings. So the concept of value can be expressed in different kind of metrics or different kind of definitions, and then it will be considered a factor because it is robust. And number 4 is that it must be investable, because if it's just a theoretical academic pursuit, right, and it's not replicable in real life, then it defeats the purpose. So it must be investable. And lastly, it must be intuitive. Because there is always a backlash on all this quantitative research, because many people start to label them as you are just data mining. Over time, you'll be able to find something that, yeah, indeed, particular phenomenon will generate excess returns just purely based on data mining itself. So number 5 tends to want to remove this data mining issue by saying that it must be able to explain why it worked. Okay, so in terms of the explanation, if you read throughout the book, there are 2 schools of thoughts to explain things. One is the risk-based theories, which says that if in order for you to get excess returns, you must take excess risk. Okay, you must take additional risk. So for example, buying value stocks, they are actually taking more risk because they feel that these stocks generally are weaker than their counterparts, and that's why they are priced lower. And by investing in them, you tend to take higher risk. So that's a risk-based theories. And the other side of the explanations are more behavioral finance in nature. So they are saying that because we cannot expect that every investor is rational in their decision-making process when they invest, so they make mistakes. They make cognitive mistakes because of biases and etc. So for example, I talk about small cap stocks that have high returns, likely because most investors do not like to invest in small cap stocks, which you think that they are not stable, and big cap stocks are a lot more safer. So there is a certain bias for big cap stocks, and that is why there's a price discrepancy due to the difference in the ununiform distribution of capital towards the big cap stocks. Okay, so it depends on how or which frame of explanation do you believe in, whether is it risk-based or behavioral finance based. So it should have a reason why this particular factor is working out. Okay, so a factor can only be qualified as a factor when they have all these 5 characteristics as mentioned here. Alright, so all the factors that has been mentioned in this book has passed all these 5 criteria. And this is how the structure of the book is shown. So Sudra and Birkin went through the 5 factors in the stocks, and in each factor they will go through the 5 criteria. So they run through whether to discuss how persistent they are, how pervasive they are, robust they are, investable and intuitive they are. Okay. And they do it likewise for the bonds, and as well as there are a lot of appendices that talk about other things such as dividend, whether is it a factor or not, which we'll cover in the later part of this webinar, as well as the low volatility factor as well. So it wasn't in the main part of the book, and it was put in the appendices. Okay, so this is where I'll share what I like and what I dislike. And I think because if you structure the book by factors, it's a lot easier to refer. So especially if, let's say, you want to find out a particular factor first, for example, you want to find out momentum first, you can just flip to that side. So it's a lot more structured in that sense. And it's simple to understand because a lot of jargons and concepts are used minimally. They still exist, but they are minimal. Okay, over time you should be able to get familiar with them. And what I dislike is that, in fact, half of the book are in appendices. So it seems like the probably it looks more like a draft than a proper book, because you don't expect appendices to be covering majority of the book itself. Okay, so half is a bit excessive in my opinion. I thought some of the appendices could have been covered in the main part of the book rather than being put in the excess pages at the end.